Take a look at the floor of the New York Stock Exchange. For decades, this chaotic, high-stress environment was what investing looked like. Picking individual stocks meant constantly trading, guessing, and exposing your money to the risks of a single company's failure. An ETF, or exchange-traded fund, strips away that complexity. It is a single basket holding hundreds or even thousands of different assets. Instead of betting your life savings entirely on one company, like Apple, you buy a tiny slice of the entire market. By holding multiple companies at once, an ETF inherently reduces the severe volatility experienced with individual stock picking. But moving away from individual stocks introduces a different problem. There are over 2,700 ETFs currently trading on the market today. That is nearly as many funds as the 3,600 individual stocks available to choose from. Selecting from that list of 2,700 options without a plan can undermine your long-term growth. If you pick fund at random, you can accidentally over-concentrate your portfolio's risk into a single sector, or get trapped by hidden management fees that erode decades of compound interest. This chart illustrates the core trade-off in the market. Picking individual stocks demands massive research effort and exposes you to high volatility. Broad ETFs sit down here in the bottom left, requiring significantly less time while keeping your portfolio's volatility mathematically contained. To build wealth, simply accessing the market isn't enough. You need a customized, goal-based strategy to filter out the noise and select the specific ETFs that align with your financial objectives. The first step is running those 2,700 ETFs through database tools to filter them into categories that match your current life stage. A 25-year-old might screen for aggressive growth funds, while a 55-year-old will prioritize high dividend yields and bonds. Every filter comes with a specific trade-off. If you optimize an ETF for immediate, high-yield dividend payouts today, the fund will capture less long-term capital appreciation. It is difficult to maximize both simultaneously. This scorecard graphic shows the three-part health check you should run before buying any ETF: verifying the fund's summary goal, analyzing its expense ratio, and checking its 10-year historical return. The expense ratio is the fund's annual management fee. Prioritizing ultra-low percentages, like the 0.03% charged by the Vanguard S&P 500 ETF, is critical. Over a 30-year horizon, even a small fee percentage can compound into thousands of dollars in lost gains. The trade-off for these low fees is that you will largely be excluded from highly specialized, actively managed niche ETFs. Funds focused on specific sectors, like blockchain or semiconductors, typically charge higher premiums for that specialized access. Next, check the 10-year or since inception return rate. A high return over a single year is often an anomaly. You must verify what the fund averages across an entire decade to determine if its performance is historically reliable. Applying these filters protects your capital from excessive fees and ensures the fund's objectives actually match your personal investment timeline. There is a common misconception that simply buying multiple different ETFs automatically guarantees a safe portfolio. In reality, if those funds hold the same stocks, one localized market hit can trigger a simultaneous collapse across your entire holdings. This is called fund overlap. To see how it works, let's look at two of the most popular broad market ETFs, VOO and VTI. This Venn diagram compares their internal holdings. By weight, VOO and VTI share an 80% overlap. For every dollar you put into one, 80 cents is buying the same top companies as the other. Holding both creates a false sense of security. Because they share the same top holdings in the tech sector, a sudden drop in that industry will send your supposedly diversified portfolio into a steep decline. The mathematical antidote to fund overlap is asset correlation. This measures how your investments move in relation to one another. This horizontal scale represents the correlation coefficient. VTI, representing the broad market, is marked at +1. Real estate funds like VNQ sit further down the scale at 0.66, while funds like SPXS sit all the way over at -1. Blending your stock ETFs with lower correlation assets, like real estate or bonds, ensures that when the stock market falls, your other assets are more likely to hold steady. This effectively smooths out your portfolio's overall volatility. But by minimizing your downward volatility, you inherently limit your maximum possible gains during a rising market. Reducing risk always has a price in performance. Be careful with negatively correlated funds. If you hold VTI at +1 and SPSS at -1 in equal amounts, their price movements will cancel each other out. Your portfolio will remain flat, neutralizing your ability to build wealth. Diversification is not measured by the quantity of ETFs you own, but by how mathematically distinct their underlying assets are from one another. Many of the ETFs you buy will pay out cash dividends. By default, that cash is simply deposited into your brokerage's settlement fund, where it sits entirely uninvested. To prevent that cash from sitting idle, you need to utilize a dividend reinvestment plan, or DRIP. This cyclic flowchart tracks the automated process. The cash payout from your dividend flows directly back into the market to buy fractional shares of that same ETF. That larger block of shares then triggers a larger cash payout on the next cycle. Leaving this constant reinvestment loop running untouched for years is what creates exponential wealth growth. The trade-off of utilizing DRIP is immediate liquidity. By automatically reinvesting that cash, you sacrifice the ability to use those dividends as spendable passive income today. DRIP functions as the primary automated driver for long-term wealth building, provided you do not require that immediate cash flow to cover your living expenses. Crafting an ETF portfolio is a process of balancing risk tolerance, asset correlation, and your compounding timeline. This decision tree shows that your primary filter for choosing a strategy comes down to your primary investment timeline. For an absolute beginner, the strategy relies on simplicity. You buy a single, low-expense, broad market index, turn on DRIP, and ignore the daily fluctuations of the market. If you are a long-term optimizer in your 20s to 40s, you focus on aggressive growth ETFs. You accept high market correlation and avoid bonds to maximize capital appreciation, while auditing your funds to eliminate overlap. As you near retirement, you must shift your strategy toward preservation. You introduce low correlation bond ETFs and dividend-focused funds to protect the capital you've spent your life building. This demographic may also choose to turn DRIP off to capture immediate cash flow. You accept lower overall portfolio growth in exchange for immediate financial stability. There is no universal ETF portfolio. The correct strategy is the one precisely aligned with your current life stage and your specific exit timeline.